Welcome to your desk side portfolio review. I am so glad you're here with us today. Look, if you've been glancing at the news lately, you know it feels like we are just completely surrounded by chaos, right? But here's the thing. As an investor, your job isn't to react to that chaos. Your job is to understand it. So today, we're going to cut right through those sensationalized headlines and separate the pure market noise from the actual actionable signals for your money. In this explainer, we're going to transform all that anxiety into a really clear, grounded strategy. So let's dive right in. Here's our roadmap for today. 1. Avoiding viral finance traps. 2. Unpacking private credit panics. 3. Geopolitics, oil, and markets. 4. Sovereign funds and retail risk. And finally, 5. Your actionable investing playbook.
All right, part 1, avoiding viral finance traps and the truth about prediction markets. If you spend any time online at all, you have absolutely seen this stuff. There's been this massive explosion of influencers promising huge, guaranteed returns. They'll tell you it's an easy 10% gain, just placing trades based on the news, right? They are pushing retail investors to bet on literally everything, from when sensitive political files are going to drop to global warfare. And they dress it all up to look like sophisticated trading. They pitch it as this highly innovative way to profit off your own unique insight into current events. But reality check. It's basically like rolling dice at a casino. A recent independent blockchain analysis came out and revealed a pretty sobering statistic. 84% of Polymarket users actually realize losses. 84%. For your average retail user, the median return on these prediction markets is negative. Once you factor in platform fees, it's essentially a negative-sum game that's completely dominated by a tiny, tiny fraction of professional arbitrageurs. So the signal here, the takeaway, is really about the fundamental difference between investing and gambling. True investing, that requires a real edge. You're analyzing a business's actual cash flows, looking at balance sheets, holding for long-term growth. Gambling on headlines, though, means you're just guessing on unpredictable binary news outcomes where you face a massive risk of a total capital wipeout. These prediction markets, they offer you a capped upside if you're right, but 100% downside if you're wrong. Guys, that is not an investment strategy. That's entertainment. Moving on to Section 2, unpacking private credit panics and understanding market contagion. So what exactly is private credit? Well, it involves non-bank investment firms stepping in to act as direct lenders to private businesses. And this industry absolutely exploded to fill the lending gap left over after traditional banks were hit with super strict regulations post-2008. But lately, we've got a much harsher macroeconomic environment, specifically high interest rates, and that has caused some highly publicized borrowers to default on those loans. In response to this, several massive private credit funds have started to gate, which basically means they are restricting everyday retail investors from withdrawing their money. Which naturally leads to a pretty terrifying question. Is this the 2008 financial crisis happening all over again? I mean, when you hear about gated funds, it's genuinely scary. Think of it like a really crowded theater where someone yells fire and everyone immediately tries to squeeze through one tiny exit at the exact same time. To stop a fire sale of illiquid assets, these funds just lock the doors. If you're an investor trapped inside that fund, you might legitimately wonder if a systemic global financial crisis is brewing right under our noses. Well, take a breath because the data signals that this is not a repeat of 2008. Why? First off, there is significantly lower systemic bank risk today. Second, these private credit funds use way less institutional leverage than the big banks did 2 decades ago. Third, we are total missing that massive, complex web of toxic mortgage derivatives that actually brought down the housing market. Today, the defaults we are seeing are largely isolated to very specific, heavily leveraged sectors, like private software companies, for example. So yes, the pain is real, absolutely, but it's largely contained to the investors holding those specific funds. It's not threatening to topple the entire global banking system. Let's pivot to Section 3. Geopolitics, oil, and markets, translating global tensions. All right, whether we are talking about a sudden U.S. raid in Venezuela, escalating military conflicts involving Iran, or even domestic political instability, like the push for Alberta's separatism in Canada, we have got to look entirely past the political theater. As investors, our sole focus has to be the economic risk. How do these events actually disrupt global supply chains? How do they impact energy distribution or the flow of capital? That's the signal. Take the conflict in Iran, for instance. The real economic danger there isn't just broad regional instability. It is specifically the Strait of Hormuz. This one single, incredibly narrow choke point handles nearly a third, 31%, of all seaborne crude oil globally. If that strait is closed,
or even heavily restricted due to conflict, we aren't just looking at local supply issues. We are staring down the barrel of massive, immediate global inflation and the very severe risk of central banks worldwide hiking interest rates to combat it.
And similarly, let's look at the noise around Venezuela. Following that recent U.S. raid to capture Nicolas Maduro, you saw all these sensational headlines implying the U.S. could just flip a switch, tap into Venezuela's massive oil reserves, and completely replace Canadian crude imports overnight. But the signal cuts right through that noise. The reality? Venezuela requires over $100 billion and a full decade of work just to rebuild its completely ruined, neglected oil infrastructure. It's not an overnight fix, not by a long shot. Plus, it just doesn't make economic sense in our currently oversupplied global oil market.
And hey, even right here in North America, we see noise disguising economic reality. The political movement for Alberta to separate from Canada is a great example. It often promises this sort of fiscal utopia, but strip away the politics. The economic friction is severe. Breaking away would likely increase non-tariff trade costs by up to 8%, risk a $20 billion annual economic loss, and trigger immediate corporate capital flight. Markets absolutely despise political instability. And building a new standalone economy solely on highly volatile oil revenues, that is incredibly risky. Okay, Section 4, Sovereign Funds and Retail Risk. The Canada Strong Fund. You know, governments love their massive nation-building projects. And right now, Canada is proposing a new $25 billion sovereign wealth fund to develop infrastructure. Proponents of this love to point to Norway's massively successful $2 trillion fund as the blueprint. But here is the catch. Norway's fund was built on actual national budget surpluses and nationalized oil revenue. They had the cash. Canada, on the other hand, is currently running a federal deficit, which means they are effectively borrowing this $25 billion to fund private infrastructure projects. Fundamentally, it's a debt-funded venture. Now, what makes this particularly unique and why we're talking about it today is that the government is inviting everyday retail investors to jump in alongside them. But before you do that, you really have to weigh the actual risks. First, infrastructure is extremely illiquid. You can't just sell your stake in a new bridge on a random Tuesday, right? You might literally be locked in for over a decade. On top of that, you have to consider the very painful history of federal cost overruns, massive regulatory risks, and the real danger of home country bias. You really don't want to over-concentrate your retirement savings into the exact same localized economy where you already earn your paycheck.
Which brings us to our final section, Section 5, your actionable investing playbook, separating signal from noise.
After all that chaos, here is exactly how you actively protect and grow your money today. Step 1. Limit your exposure to illiquid assets. Whether it's a gated private credit fund or a 10-year government infrastructure project, just make sure you aren't locking up money that you might need in a pinch. Step 2. Avoid trading on headlines. Seriously, stop treating your portfolio like a prediction market casino. By the time a geopolitical headline actually hits your social media feed, I promise you the smart money has already moved. And step 3, diversify globally. Do not let home country bias or highly concentrated bets on a single sector like software or oil leave you exposed to random regional shocks. So as you look at your own finances this week, I really encourage you to just take a breath. Tune out the daily panic. Stick to the fundamentals. In fact, take 15 minutes this weekend to just review your asset allocation and ask yourself this one final question. How resilient is your portfolio today? If you follow the signals we just outlined, you are going to be well on your way to building a wealth strategy that actually lasts. Thank you so much for joining me for this explainer. Keep focusing on the signal, and I'll see you next time.